My name is Michael Scarpati. I'm the founder of RetireUS, retire.us. And I've spent 15 years in an industry that is both vital to everybody and broken. And my objective with the company and what we've built with the platform is to give people a little bit of a better chance to create financial freedom with trusted experts that can help guide them and ultimately give them a plan for success.
All right. So you said that the retirement system is broken. What do you mean by that?
So, well, at least in the U.S., I can't speak to the EU, but in the U.S., the industry is broken in that the vast majority of licensed financial professionals are not legally obligated to work in the best interest of the client. They have what's called no fiduciary standard. And so as a result, most people are getting their advice from professionals that represent an institution, not the actual client themselves. And we're here to change that. We're here to create more accessibility to the highest level of professional for a fraction of the industry standard cost to give more people the opportunity to create a financial plan and create a path to financial freedom with a trusted licensed expert.
So what's wrong with the standard route? Is it the high fees or is just the financial advising not on such a high level?
Well, the system's stacked against people, everyday people, and it's because the industry is structured and dominated mainly by institutions. So the big things, when people think of financial planning, the first thing they really think about traditionally is their products, their portfolios, right? Their stocks, their bonds, their mutual funds. And the industry is very top heavy for product first institutions, right? The institutions, the big ones that come to mind when you think about investing, right? They are in the business of gathering more and more assets into their products. And so the reason things are kind of broken is most of the financial professionals that are licensed and employed, at least in the States, they actually work for those larger investment institutions. They're not independent. They actually aren't working directly for the end consumer. And so what that does is it kind of shifts the priority of advice. The priority of advice becomes the products itself versus putting together a system, a plan of the bigger picture of how the financial components of our life need to interact and operate with one another before we choose the products that fit within that larger system. And so that's what I mean when I say things are broken. It's the entire perspective of how to give financial advice is kind of flipped in a way that drives intention and attention towards product versus planning.
It sounds to me like those people are more of salespeople rather than financial advisors.
Exactly. Yeah. I mean, that's that's a good way to kind of think through it is that who does the professional represent, right? That's the first question we should really ask ourselves when we're getting advice from a professional in the industry. Does this person represent me or do they represent a specific investment company or an institution? And that can kind of help you shape your understanding of what the incentives and the quality of the advice may be by having that higher level of understanding of how it kind of all works.
Exactly. So coming back to your business, how is your business different than the standard route?
Well, RetireUS didn't start to make finance better. It started to make it fair. And the system is stacked against the everyday people because advisors chase commissions and products come before people and the actual planning is rare. So RetireUS flips that. We connect people with independent fiduciary planners at a price that everyone can afford. And that way they can build a plan first. We also connect them with these independent fiduciary product advisors that have what's called an open architecture, meaning they're not tied to any one company's products or services. They can vet the entire marketplace. So our mission's simple. It's to make creating financial freedom possible for everyone. We believe that starts with fiduciary trusted guidance from a planning standpoint first. before products even enter the equation.
And in my opinion, especially, it's very important for retirement savings, as through the power of compounding, it can be a really great investment. Can you expand on that?
Yeah. Compound interest is the closest thing to magic in finance. It's not just earning interest, right? It's earning interest on your interest. So over decades, that growth curve turns exponential. So every year that you wait isn't 1 year lost when we're talking about compounding interest. It's actually decades of future gains that are gone, because time is the most powerful investor that you'll ever have. And compounding interest is the way that you take advantage of that time.
But do you see a problem that people wait, for instance, too long before they start thinking about their retirement?
Most people do. Yeah, most people do. I mean, most people wait until, not necessarily too late, but they've definitely made the opportunity to hit that goal much more difficult, right? They've made it more challenging because time is one of the biggest assets that you have. It's not just the money that you have, right? The other big factor is, how long is that money cooking there for? How long is it actually sitting there and working for you, right? It's another worker in the room. And the longer that we wait, the less work that can do for you on your behalf. So you see it a lot. Most people, unfortunately, wait until they're in their 40s and 50s to really start taking retirement planning seriously. And it's always to the detriment of their ability to hit that goal. So the earlier that you can start, right, the earlier that you can just get some sort of systematic savings and some of that money that you have in excess working for you, the easier it will be in the long term.
And on the other hand, do you think there is an age that is too early to start investing or thinking about retirement?
No, definitely not. Definitely not. The earlier, the better. Now, the more, starting is the hardest step is the first step, which is just getting started, right? Most people actually struggle with that because of a couple of reasons. They either fear taking a look at it, right? They're just afraid of seeing the actual numbers because that makes it real. That's the unfortunate reality. But what we need to acknowledge is, the longer that we wait to make it real, the harder that it actually will become to pull that into reality, right? The harder it will be to actually make that true in our lives. And so the earlier that we can ever start, the easier anything we're going to do financially is going to become. So in my opinion, there's no time like the present, right? The earlier, the better to get started in any capacity. And then you'll learn over time, right? As you're in it, the more you will learn how to improve upon those financial decisions that you're making.
And some people, especially right now, in the past years, there was a significant inflation. People are scared to invest because they think that inflation is going to actually eat away their money, and in reality, they are going to lose. Is this true? Are there some investments that will lose to inflation, or are there also investments that can benefit from it and grow according to it?
Well, so that's an interesting perspective. Is the inflation itself, right? What would be helpful is let's talk about what is inflation really, right? What is inflation really? Inflation is the rate at which things are getting more expensive. Traditional costs, products and services, right? Traditional costs in our life, it's the rate at which things are getting more expensive. And so when we're thinking about our investments, what we want to make sure our investments are doing at a minimum is keeping pace with that rate, right? So let's say inflation's at 3%. Well, if we have all of our money, all of our savings is in a checking account or a savings account that's earning 0% or 1%, that money's losing value. So that would not be a great place to have any money that's for the long term, because every single year that inflation outpaces that account, the money's becoming less valuable, right?
Mm-hmm.
So on the flip side, there's plenty of investments out there. Just rule of thumb, the S&P on average, the S&P 500 has historically averaged anywhere from like 9 to 10% per year when you kind of backdate everything.
Mm-hmm.
So if your inflation is at 3% and all the money is in an S&P 500 index fund, right, we're outpacing that by close to 6-7% per year. So not only is the money keeping pace, right, it's not losing value, we're actually outpacing the inflation, right? We're earning more interest and growing that at a faster rate than things are getting more expensive. So it's understanding, right, what the relative inflation rate is for your life, right, where your expenses have the rate at which they're getting pricier, and making sure that the money that you have on the sidelines is at least keeping up with it. But if we're talking long term, we want to make sure that it's outpacing it.
Mm-hmm. And especially after COVID crash, when the inflation was high, the stock market started returning even significantly more than this 8 to 10%. Is this because
Yeah.
some of the businesses, because they are not the consumers, but they are the producers, they can raise their prices according to the inflation? Maybe the inflation doesn't hit them as much as it hits the regular consumer.
Yeah, I mean, with the COVID crash is just markets are cyclical traditionally, and markets go up and markets go down. And when markets crashed so significantly during COVID, I mean, there was a really great opportunity to buy, right? There's a great opportunity to purchase investments and stocks and mutual funds, things on public markets that were undervalued in the grand scheme of things, right? And so you saw a lot of tremendous growth. And since COVID, for the most part, you've seen consistent growth in the markets that have well outpaced inflation and other things. So finding those opportunities will always be beneficial, but also historically, just time in the markets is one of those things too, that is just continuing to not letting fear force you to pull money out when it's kind of at the bottom of that COVID crash is also key to be aware of. Things continued to increase, right around the COVID time, because there was an influx in consumerism, right?
Mm-hmm.
The public markets, people had nothing to do. A lot of people were locked in their house and just spending money, right?
Mm-hmm.
A lot of people were spending money in areas that they otherwise weren't before. And so you saw this big push in consumerism right around the COVID time, and that kind of transitioned into propping the markets back up. You had a lot of people that had more discretionary money and started investing more. You also saw a big influx in investors because of the Robinhoods, because of the fintech platforms out there that create more accessibility. All those things helped prop up the markets and create stability in the public markets around that time too.
Mm-hmm. Also, the inflation encouraged people to invest, encouraged them to spend. But do you think we can say that maybe these saving accounts aren't then so safe if you can lose money on them during times of high inflation? Especially maybe when we compare it to government bonds, aren't they safer and bring us better value than just saving accounts?
Well, when it comes to investing, safety is relative, right? Safety is a term that's relative because everything that you put money in has some level of risk. It's just you're transferring those risks around different types of challenges, where in the investment markets, it's going to be market risk, right? You can lose actual dollars on the statement value, right? You can see that number actually physically go down. In a cash account, checking account, savings account, it's an inflation risk, which is you're not seeing the value go down on paper, but it's actually going down in your ability to purchase goods and services. So I think what it comes down to is understanding, how much of your money should be in various types of risk, right? It's not an all one size fits all approach. You want to have liquidity, you want to have money in checking and savings. It's just there's a level of when it becomes too much, right? After you have 3 to 6 months are traditional rules of thumb for your expenses, 3 to 6 months of your expenses in those cash accounts. You want to make sure that anything else in excess is working definitely harder than the inflation rate, right? So it's a balancing act. It all comes down to what you need and how much should kind of be in each of those different buckets of risk, if you will.
But also our savings accounts and the banks that provide the service, they use leverage. Like for instance, in 2008, we saw that this money is not really safe as we think.
Yeah, I mean, there's right, credit risk. There's another risk that goes along with savings accounts. It's essentially credit risk. It's banking risk, really, but it's the ability for the banks themselves to pay back the loan that you're giving them to hold the money, right? The money in the savings account, banks have leverage where they can leverage the money depending on the area you're in, up to 10 to 1 on the amount of money that's in their reserves they can actually loan out to other patrons. That's really how they're making their money. So for every $100,000 that's in the bank, they can theoretically loan out $1 million, right? And it's all just, numbers on paper at this point, the way that that's all working, or on your computer screen. And so banking has its risks as well, right? Which is, will the bank be able to pay back its debts to you? That's on the balance of your savings or checking account. You saw that actually with Silicon Valley Bank a couple of years ago. There was a big run on the banks, right? Think about a big run on the banks means a lot of people go and start to withdraw their money, but like we just mentioned, they don't have all the money, right? They've loaned it out. That's how a bank works. So all the money is not sitting, in their safe. It's in, the mom and pop shop down the road that needed a loan to expand their operations, or, for the family that needed to purchase a home, right? This is where the money actually goes. And so in the States, they have something called FDIC insurance, which is up to $250,000 in the bank that you're at. There's basically government insurance and protection in case the bank goes under that will be there to help make you whole. But once your deposits are over those limits, then it's uninsured, and you're just banking on the fact that the institution itself is solvent and will ultimately not run into issues of insolvency. So, like I said, anywhere you place money has a risk, even if it's under your mattress, right? If you put it under your mattress, guess what? It's got inflation risk because it's losing value, right? So no matter where you put money, it's always going to have risk. Understanding the risk is the biggest thing. Understanding which type of risks you're exposed to, and if they're right for you, is what we would always suggest kind of doing a little bit of an inventory check on.
And thinking what type of volatility is good for a certain investor, what's their risk tolerance, and do they want to safely invest that money, or maybe they want to have higher risk but also higher profits. Yeah, it's all important when talking to a financial advisor. And I guess if you don't use a financial advisor, but somebody is selling you some retirement plan, they can just propose to you the thing that rose the most in the past, because that's what people are most likely to buy into, which often is something that is expensive.
And also, historic results don't dictate future returns.
Yeah.
It's one of the disclosures that you see everywhere when it comes to investments, because there's no guarantees in investing, point blank, period. And particularly something that's done well in the past doesn't mean it's going to traditionally do well in the future. You're going to see that dramatically over the next 5 to 10 years in the age of artificial intelligence, robotics, and quantum computing. There will be companies that have been mainstay companies that have done great for years. And the history would say that they're going to average high levels of return, and those companies will be non-existent in 10 years. So you got to be very thoughtful in the way that you make those decisions, and just keep in mind that history doesn't necessarily dictate the future as well.
That's why I think it can be difficult for everyday people, non-finance people, to pick the right investments by themselves, because they look at the past, but it really doesn't work like that, as you said.
Yeah. What you want to do is be more strategic in understanding the asset classes themselves. That's a better measuring stick than the companies themselves. So understanding specific asset classes, like large cap is a major asset class that most people are aware of. Like S&P 500 is large cap, large companies, really large companies, large revenues, right? There's a different level of risk associated with investing in large cap assets versus small cap assets or emerging markets, right, that are not yet as established. And so there's different levels of risk, but there's also different levels of expected or associated returns with those risks based off of the asset classes and their potential to grow, right? And so it's really about having a good balance between various asset classes, because they all have inherently different levels of risk associated with different levels of return. And how you balance that asset allocation, that's something that starts to at least create a little bit more predictability and a little bit more stability with how you can kind of navigate forward. Still, things are still going to be volatile regardless of where you invest. There's opportunity for volatility, but having a good diversification between differing asset classes is a really good starting point for most people to start creating a little bit more stability and accountability within the portfolio for their expectations of growth.
And your clients and your business, with what types of asset classes are you guys working with?
So RetireUS is not directly investing on the behalf of the client. We're connecting you with the independent fiduciary professionals, and those professionals have what's called an open architecture. So there's really no limitation on where they're gonna bring things. It all matters on the end user. What do you need, right? What is the level of risk that is associated with the right level of growth that you particularly need? And it's not just risk tolerance, right? Risk tolerance is very much more associated with how do you feel with your level of risk? How do you feel? How much pain can you endure when markets are going down, right? That's where we would measure our tolerance. Risk capacity is also important. Risk capacity is how much losses can you actually take without destroying your entire ability to hit your goals, right? Where is that threshold? And how do we find the middle ground between the two? That's where these professionals kind of start the conversations. And then leveraging that data, they're able to then vet the entire marketplace and find what is the optimal way to spread that risk around in order to make sure that we're moving forward, minimizing the exposure as best as we can.
Oh, okay, that's really great. And so, does it change according to the age of the client?
Age is one factor, but it's actually really more dictated by timeline, right? It's by timeline and progress. So age is kind of irrelevant, really. It's just a benchmark that we can understand, because typically people set their retirement goals in terms of age as well, right? So age becomes a benchmark, but really what we're doing is we're looking at what is the timeline between now and your retirement goal. That's a better measuring stick, because timeline and progress, and then ultimately the end goal of where are you going? What do you need from this amount of money? You have $1 million, you have 10 years, but you need 2 in that amount of time. that really should be dictating everything, because we can do the math to figure out, okay, that means if we're saving X amount of dollars per year, we need Y level of return to get from 1 million to 2 million in a 10-year time horizon. That then dictates, all right, based off of this level of return we need to target, how can we do that optimally without exposing ourselves to unnecessary risks, if that makes sense.
Yeah, it does. And what, in your opinion, is a good retirement? How people should look at it?
Help me understand what you mean by that, by good retirement. Let's unpack that a little bit more, just so I can give you the best answer.
So, do you think that there is a certain amount of money that people should invest every month? Is it based, like, is it like a percentage of their income that they should be thinking about investing, or is it like a certain amount?
I got you. Yeah, it's either or is fine. What I would actually, the right answer tends to be first understanding what you need to have saved. What is retirement going to cost you is the first step of unraveling the retirement equation. So in 10 years from now, if that's your retirement goal, what is life going to cost? How much money do you need per month, per year, in order to recreate your lifestyle? That is the most important data point, because from there, we can then unravel, well, how much do we then need to have saved up in 10 years in order to recreate this income every single year for the next 30 plus years, while keeping up with inflation, while navigating tax implications, that sort of thing. So understanding the lifestyle cost in the future, right? Then reverse engineering at one time to figure out, well, what do we actually need to have saved in order to recreate that amount of income, right? Or at least supplement other sources of income that we will have in the future, like pension income or Social Security or the equivalent of that. That's really, we need that information first. That really should be the basis of your decision making, because once you know how much you need to have saved up and you know how much you have now, it's just math, right? It's math based off of what's the average return that we're going to get every year, or, at least target to get every year. We can solve for it. You can literally do the solve to figure out exactly how much you would need to save month over month, year over year, in order to be on pace to hit that goal. So starting somewhere with a percentage or a dollar amount is a great way to just get started, right? There's no right or wrong answer in order to get started, but there is a right answer on how much you need to be saving, but it's actually based off of what you need in the future. And you need to do that work first and kind of back end into it.
And what do you think is the outlook for retirement in the US? Are the things going better, or do you think it will just get worse in the future?
The outlook, you saying?
Yeah.
I think the outlook's good for most people, because traditionally what we see is people retire and they actually tend to require less money than they projected in retirement. Things kind of start to normalize, and people just don't spend as much as we traditionally project out. I mean, that's one of the things that you do see pretty often. The outlook is positive, I think, from that standpoint, is that it does end up being more manageable than most people think. On the negative side, there are some things that are more than likely going to change on the fixed income or the government support, particularly in the United States. Social Security reserves are dwindling pretty quickly, and you're having more and more people in the baby boomer generation entering the retirement phase. You have less and less people actually statistically in the workforce from college grads entering into the workforce. And so, Social Security is in essence a Ponzi scheme to an extent.
Yeah,
it's being paid for.
Sadly,
yeah, it's paid for by the people that are getting retirement benefits and Social Security. That money is essentially coming from people that are in the workforce for the most part. So you have this diverging economic situation that something's going to break and something needs to be refactored at some point. So the more conscious we are and the more proactive that we are at privatizing our own savings, privatizing our retirement plan, the more prepared we're going to be for however that does ultimately shake out. So the outlook on government support is probably not so great for the long term. The millennial generation, Gen Z, Gen Alpha, these generations probably need to be much more proactive in creating private savings to have that outlook continue to stay very positive for retirement.
Yes, especially with the lower birth rates, the demographic can be a huge issue.
Yep. Great call. I mean, it's just another one. Less and less people are entering the workforce consistently from higher education, and then less and less humans are being born. Something's going to break at some point if the way to fund retirement income is from the previous generations, right? So something's going to have to change. It's just a matter of how and when those changes affect the public.
Mm-hmm. And let's say that something happens to you. Maybe you have some disease or an accident. Can you use those retirement savings earlier? Just like the sort of a security thing?
Yeah, typically you can. Typically there are loopholes and ways that you can access money without penalties or but traditionally, at least in the States, most of the retirement savings is pre-tax. So it hasn't yet been taxed by the federal government, which means that regardless of what your needs are, that is going to be taken out first. Like that is a requirement of making a withdrawal from those accounts. So it's something to be mindful of. It's one of the things I think a lot of folks don't consider when they're thinking about forecasting potential long-term health concerns in the retirement, right? Going into assisted living, going into some of these areas where you need a lot of money, sometimes hundreds of thousands of dollars per year it costs in the States for a lot of people to get that level of care. And all that is going to have to come out of these retirement accounts pre-tax. So you're going to need more, right, than what's actually the cost, because taxes are going to be entered into the equation too. So it's something to just be mindful of. But you can access the money for it, but there will be generally tax implications if they're coming from retirement accounts.
All right. So it's less optimal. That if something terrible happens in your life, you can also think about your retirement savings as this money for the bad times that can save you.
Yeah,
okay,
exactly.
That's great. All right, Michael. Before we wrap up, can you please tell our audience where they can go to find more information about you and your company?
So RetireUS online, RetireUS, that's the best place to get the most information about the platform, financial mindfulness, financial consciousness, building up ways to create just more financial health for you and for your life. We have a handful of tiers on there. One is a free mindfulness tier that you can get started and take a financial checkpoint to get kind of a pulse check of where you stand right now. And then on social media at RetireUS on Instagram and on LinkedIn. I'm also pretty active on LinkedIn as well. Michael Scarpati, CEO and founder of RetireUS. You can find me right there on LinkedIn to follow along if you so wish.
Yeah, that's great. I can see that you know a lot about finance, investing, retirement, and yeah, as you said, the outlook on the social security and the products that the big institutions are offering in the USA, it doesn't look great. So it's really nice that you are offering a different solution that is focused on the client, that they are the real benefactor of that.
Yeah, thank you. It's our pleasure.
Thank you very much for the podcast.
Thank you. I appreciate the time.